Why is real estate investment a high risk investment? I'm going to say it can be, and you can mitigate it with a lot of strategy. So let's dive right into how do you actually reduce the risk of investing in real estate, especially in this economy. We're in a volatile recession with high interest rates. That's a big problem, which I'm going to just add it in right now. The interest rates tying to the lack of insurance and the amount of insurance companies canceling makes it a higher risk. So we're going to talk about three things. How do you even understand and look at the validity of the risks of the deal? And how do you really mitigate those risks as much as you can? Number two, the key factors that will make or break your deal or that are absolutely critical success factors. And then the third, we're going to talk about the common mistakes that I see a lot of people make that just cause it to go from a very low or moderate risk investment to high risk. So let's begin. So what are the inherent risks of doing a deal? Anyway, I'm just going to read off some of the data that we found that you're going to be hearing about, and you're probably obvious about some of this. Market variability. They fluctuate greatly. I'd say it's zip code specific. Even if you're in the California market, the New Jersey, New York, Pennsylvania, Minnesota, 5 of the roughest states with tax issues right now. The bigger part of that is we have a huge push to be a renter nation, not a landlord nation. So you better know your state's landlord laws because you're going to have problem tenants. And like right now, California, for example, they're looking at implementing a 12-month squatter right law where anybody could sit in your property. So why be a landlord in a state where you can't kick out a tenant? You want a landlord-friendly state. The other problem that California is looking at, which is probably going to spread across the country a little bit, is an exit tax. Basically, you sell real estate in a wrong state and then you get the capital. You have to pay to exit. If you wanted to move, say, from California, you want to move into, say, my favorite markets, Kansas, Oklahoma, Missouri, like the Midwest markets, you have to pay an exit tax to take your money out of the state. This is becoming ridiculous. Ridiculous, ridiculous. The other high risk is just property management. So my answer, I'll just tell you on property management, is actually own the property management company yourself. So whether you're going to do the bookkeeping on it, you've got to do bookkeeping if you're going to go to OPM, but property management, if you do not know how to manage managers, could go up as much as 10% of the rent plus every cost. I've seen people completely topple their cash flow by not doing a proper cash flow process. The other thing I want you to do in the show notes below, I'm giving you the first 3 chapters of my wealth cycle investing book. You've really got to get the rest, but I have pages of due diligence, the 5 Ds of due diligence. How do you actually do risk analysis? What are the forms you use? How do you structure it? You need to understand the math to make sure you mitigate the risks. The other problem with California and a few other states is they have mansion tax. What does that mean? If your property's worth $5 million to $10 million, you're going to pay a 4.5% to 5% additional tax on owning that kind of mansions. So it's fascinating to watch, I'm just going to say Washington. We'll leave the political parties association out, but how one side's pushing for renters and absolutely constricting the landlords out of these markets. And the other side is pushing for own as much as you want when you want. I wish America would get off of its rear and buy more of its own land while the borders are open and China's in and Russia's in. Other countries are buying more of our land than America themselves. So America sits on their rear. And I've been complaining about this in 2008, 9, and 10. I did it again in COVID, and I'm doing it again now because America, you got to get up and go buy some land and buy some of your own properties. Now, how do you mitigate risk? So you mitigate risk by being in the right markets. I have this huge saying. It says, live where you want, invest where it makes sense. So I've lived in some of the greatest places. I've lived in the Lake Tahoe area now. Beautiful place. Lived on Lake Tahoe. Before that, lived in Sausalito. I've lived in Manhattan Beach. I've lived in New Orleans. I live where I want. I invest where the markets and the zip codes make sense. I've loved the Midwest. Oklahoma's been my millionaire market. I'm now heavily in the Kansas market with a lot of different apartments there. And so when you look at diversity, you want to diversify by state. You also want to diversify by doors. Now, make a decision early on whether you're going to do single family or and stay residential, which is up to 4 doors, or you're going to cross the line and go commercial. The benefit of commercial, in my opinion, to mitigate risk, especially in this kind of an environment, the interest rates are higher in commercial loans than residential, but you're going to mitigate your risk because you can probably get a non-recourse loan, which means the bank's just going to take back the property. You're not going to have to go into a bankruptcy or a foreclosure if you can't handle the property. Again, always want to do this as a team. I just coined the word team-made millionaire. You do not want to do these things alone. If you had, say, $100,000 to invest, I'd rather see you find 4, 5, 6, 10 friends, and each of you put $25,000 into 4 properties. Now you have a 25% blended risk versus if you have 1 property and all of you in one, you have a 100% problem if that goes down. Recently in Kansas, we actually had some, drunk driver, sleepy driver drove through part of our entire building, knocked out 23 of our units, through bedroom walls, it was a disaster. So we actually had the local authorities trying to call it a condemned building, where we're like, no, this part of the building's stable. You had to get out architects, engineers, say this part of the building's stable while we remodel this side of the building. In the meantime, insurance is going to double. So I'm telling you, mitigate the risk by knowing the variables of your loans, how you get into it, how you finance it, your interest rates. Do you have prepayment penalties? What's the insurance requirements around it? And again, you're going to get better insurance if you're commercial with non-recourse, in my experience. So again, you've got to know the math on how do you mitigate some of the risk. Diversifying your investments. Don't stay with one person, one state. Some of you get into these syndications. You don't even know who the manager is. You might get 4, 5, 6% returns and you think that's great. I mean, why aren't you in the 10, 12, bigger percents returns? Other things to mitigate, in addition to diversifying your investment, diversify the team, diversify your investors, including if you're using traditional banks. Do not use all the same bank, and just know your legal safeguards. So you want to use corporate structure. We use typically LLCs in the state of which the property is in, but we use our operating agreements, our rental agreements, then our property management agreements. Been doing this for over 20 years. So ours are very, very well vetted. And just some little bit of wrong legal advice could get you in a lot of trouble. So just mitigate your risk as much as you can. Love to teach and coach you about real estate, getting in with little money or using other people's capital, however you want to do it. How do you mitigate the high risk and how do you evaluate a deal? Critical skill sets. So if you're enjoying this, I want you to subscribe to my channel. I want you here 5 days a week, every day. I want you here watching the video. I'm asking for anywhere between 6 to 10, maybe 15 minutes of your time a day to pour knowledge into you. Our clients that actually are the best take this on and own it. They're not waiting for Loral's pixie dust to make sure I could do this for you. They're actually knowing how to do it and they're owning it because this is your legacy, your life, your investment strategy. So what are the common mistakes I see? Again, investing in what's convenient and local to you, wrong zip codes, you're buying too high. You actually didn't price. This is constant with fix and flips. You didn't price the actual repairs and you didn't take into account ever since COVID 2020, everything is costing more delays. Getting permits through counties take forever. I know projects that have been delayed over 18 months by local county officials not putting permits through. So all of that has to be looked at if you're looking at the cost of money. If you're spending, say, 10, 12% to get hard money, that's a lot of money. The cost of that money is expensive if your project's delayed. So just be very mindful. And again, my overall arching, conclusion of this is get a mentor who's been there, done it, and can walk you through the path. You may not make as much in the beginning, but you're going to be a lot safer, reduce your risk, have a higher knowledge base, and maybe get some better partners. So if you have any questions, go to askloral.com, ASKLORAL, ask questions, make a request, and we're here every day to help you be a millionaire.